The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Q1 is done. I'll tell you which markets have made the most returns this year so far, and how you can pick winning companies to invest in. A global analyst reveals what to look for and what to avoid. It's Monday the 3rd of April and you're watching Markets with Madison. The first quarter of the year is done and dusted, and fair to say it's been a pretty wild start for markets. Let's take a look at the numbers. We're on par with Aussie. Both our markets are up around 3%. Japan's Nikkei the leader in this corner of the world, but China's reopening is paying off too, with Shanghai's stock exchange up more than 4% year to date. Wall Street started the year with a rally, but it's since given back some of those gains. Things like bank collapses and more interest rate hikes are pretty clear detractors. The Dow's in the red, but if anyone held on to tech stocks last year, you'll certainly be smiling now. The Nasdaq is up 15% so far this year. Europe looks like the place to be. Germany's DAX and the French CAC 40 are both up more than 10%. Despite a bit of financial sector turmoil, European markets are proving to be resilient, following on from a strong Q4 last year. For a real take on what's happening in Europe, I sat down with a Scotsman from Nico Asset Management. Will Lowe is visiting New Zealand and told me how he's picking winners in this environment and why Western banks never make the cut.
I think we're seeing echoes of what we've been going through in the last kind of 12, 18 months, which is we've gone from a period where the great monetary experiment led to market excesses. We know the outcomes now where central banks have reversed policy, desperate to get their credibility back. So the repricing of everything back to a more normal environment. So that's what really dominated last year. And we've seen more of it this year, but there's been a degree of bounce in certain parts of the market. Dare I say it, the more speculative end of the market that was had a crescendo of selling tail end of last year, seen a bit of a bounce. Our best guess, it has to be said, that is nothing other than that. I think what we're going to have to position for going forward is less growth, higher cost of capital, and therefore really focusing on the type of companies you really want to own in a lower growth and potentially sustained, more inflationary environment.
So a dead cat bounce, you're calling it. When can you expect that
Not
to happen?
maybe in the broader markets. I think the leadership within the market in January this year was very narrow. Stuff that went down a lot in December, bounced a lot. But underlying behind that, I think what's always going to drive markets from here on in, we would suggest, is round about delivery of growth, the delivery of cash flow, and doing it consistently and compounding up. The very things we look for in our kind of future quality approach. I think chasing the rotation, the price of stuff, and the way things used to be priced, I think is unlikely to maybe give you the returns you're looking for. Our best guess is there's a couple of areas we find are much more likely to be that leadership. One is kind of the picks and shovels of the energy transition that we clearly need from a global perspective. One other area would be in healthcare, where the cost and delivery of healthcare is an enduring problem that has to be solved. And pretty much guarantee that voters and societies will demand it be solved. Any companies that can solve that problem with better business models to make healthcare more efficient, again, we think that's quite an enduring theme.
So you're obviously picking winners out there. How do you find them? What are the signs that you look for? And then also, once you do find them, what gives you such high conviction that those are the stocks that are going to win from those trends?
I think it gets back to, what is your compass? What's your philosophy, no matter what the market environment you're in? And we have something what we call future quality, which is where only companies are going to attain and sustain really high returns on invested capital. So companies that are either, great companies staying great, or average companies becoming even better. Most companies don't follow that path. And if you combine that with, there's a kind of 4 pillars: strong franchise, great management, strong balance sheet to survive and flourish in any down cycle, and finally you pay the right price or valuation. You stick to simple criteria that narrows the universe down hugely. And that's what we do using a very experienced team. With those principles and philosophy, you come to the range of ideas that we find in our portfolios.
Can you give us some names of the only 45 companies that are in your portfolio?
Yeah, no, I'll give an example. Take Compass Holdings. It's a global contract catering company. They had a tough time in COVID, when suddenly the requirements in your sports stadium and your office or your workplace for contract catering suddenly disappeared for a while. But if you've got a great management team, they look after their people, they've got a strong balance sheet, they've come out of that natural disaster, which what COVID was, stronger, growing market share, bigger organic growth. We took the opportunity to add more when there was a downturn there, and now it's getting back to the high returns it had in the past, and again delivering growth, and growth in an inflationary environment, which we think is really important, because those companies, you want to be invested in, I should say, in those companies that can flourish where there's more input cost inflation. And do you have the ability to pass on input costs to your customers who still happily buy your product at higher prices and maintain your profitability? In short, pricing power, that really matters.
I hear that you're quite bullish on travel, so where do you see pricing power and those sorts of fundamentals in the travel sector when it's a cost of living crisis, we call it in New Zealand, or just an inflation crisis around the rest of the world? Who's going to pay to go travelling?
Well, the harsh reality is, I'm afraid the rich are still rich, and they still want to travel and they're happy to pay for it. And the young, when you speak to the major players in the travel industry, they're going to give up on a lot of stuff. Budgets are tighter, cost of living is higher. But often the last thing they're going to cut off is actually their willingness to travel, take their Instagrams, whatever may be done. Then you add in the fact a portion of the travel population has not been traveling. For example, the Chinese. So mainland tourists will return, they'll get visas, they'll get their passports renewed, there'll be an airline capacity will return, and you're going to get more people on the global scene wanting to travel. And then finally, there's not been the supply side. Great companies and pricing power, there's two things that define that. One's clearly people's ability to demand and buy the service, but how many people are providing the service can absolutely make a big difference. And there's been no new net supply in either hotels, airlines, or otherwise. So the supply dynamics combined with demand recovery, we think there's some ways of playing that within the portfolio. For example, we own Booking Holdings, Amadeus, the GDS engine, and more recently added Samsonite in Hong Kong, your luggage manufacturer, which again, has got what we're looking for. Improving margins, improving revenue prospects, and a classic future quality candidate.
If those are the industries that you think are going to win, which industries could be set to lose?
Anything where the provision of consumer goods that have been over-consumed previously has obviously got a challenge. We never owned Peloton bikes or otherwise, but there's a good typical example. So I think what we need today, rather than that was consumed too much before using cheap money or borrowing, is likely not an area to be particularly more exciting. Second thing would be, I guess, within financials, to be highly selective. We don't own any Western banks in our global portfolios. Where we've got credit exposure, the only places we would have would be in countries or nations where the opportunity is still significant in terms of rising GDP per capita, lower credit penetration. So India, Indonesia, or interesting wealth centres such as Singapore, where we own DBS Bank, they're the only credit financials we own. We don't own anything in the West where they're commoditized businesses before, now combining with a higher cost of capital and clearly some issues at the margin, depending on the prudence around about the deposit side as well.
Would it be fair to say that you saw this coming for Western banks there?
Well, I think ever since the global financial crisis, most Western banks have been highly regulated businesses and inherently gone from way too high leverage to still leveraged business models. So again, what we look for is to view high return on capital businesses. Most struggle with that, given the capital requirements, and certainly struggle to be in improving businesses as well, given the backdrop we've had. Now we move into recession, credit charges, deposit flights, and so on. I think there's ongoing questions about the average banking stock.
So given that economic environment, you've mentioned recession just there, what are the biggest risks that you think all of that poses to globally listed companies, including the ones that you're invested in?
Well, clearly, I'd say recession has been created by a higher cost of money. Those companies that have got too much leverage will continue to be found out. And that's either rapidly in some cases, or as you get gradual repricing of debt works its way through. Or companies exposed to where the consumption was too high before. But as we mentioned earlier, there's always new leadership developing within the market. So those companies have got areas or pockets in the economy which are more interesting and have got better balance sheets. That's where the winners are going to be, which is exactly why you want to be an active investor. You know, the passive investment will give you exposure to some of the new winners, but also the losers of the last cycle. What we're trying to find, stick to your philosophy and principles and find out who the new winners are going to be in 5 years' time, which are going to be the great companies. That's what we're passionate about, and that's exactly what we put into portfolios.
Is that harder to do now, do you think?
It's always been hard. It's never easy to be an investor. There's plenty of smart people out there, so I'm afraid we would never suggest it's harder or easier. It's the same job, but if you've got the right philosophy and the right process and the right team to get those ideas into portfolios really efficiently, that's what the bit is hardest. If you get that right, you're much more likely to get that returns that I think all savers are looking for.
Thanks so much for your time. We're lovely to have you in New Zealand and lovely to meet you.
Not at all, thank you.
Now, it's a big week for the Reserve Bank this week. The market's expecting to see a 25 basis point hike on Wednesday, which would be the smallest increase to our OCR in about a year. We'll have that decision and all the reaction this week on nzherald.co.nz. But you won't hear it from me. I'm going to Wall Street. Just for a vacay. I'll be back after Anzac weekend. In the meantime, go and put your money to work.
Thanks for checking out our YouTube channel. To stay up to date with all the latest news from the New Zealand Herald, click the subscribe button below or check out one of the videos here, and head over to nzherald.co.nz for more details on these stories and more.